You have to wait for households and companies in China to rebuild their balance sheets. We saw very rapid credit growth for the decade before the pandemic. That's left the economy highly geared, and we need to see some savings accrued, some balance sheets improved, because until you get to that point, stimulus measures are going to really not get any traction.
We saw China's credit demand sort of improving, deflationary pressures also easing. Does that mean that this could prove to be temporary?
I think the inflation numbers are interesting. Of course, the negative print a month ago was largely food prices, and it was food prices that took the inflation rate back positive. So I would be a little bit wary about interpreting that figure positively. The credit data is more mixed. We were expecting an increase in government bond issuance because of the instruction to local authorities to use quota up by the end of September. And that has come through, and that's very definitely a positive. The bank lending figures, though, yes, the overall lending numbers were great, but the long-term loans to either households or corporates were quite small. So that still fits with my framework that both companies and households are more interested in improving their balance sheets than taking on new credit.
Yeah, the Japanification risk is really interesting to me, Eric, because you talk about obviously this need to wait for balance sheets in households to be rebuilt. Is it possible to do that when property is so closely tied to household wealth is in this prolonged structural slump? Is there any kind of policy response that could accelerate that?
I think that you've hit the nail right on the head. We want to keep the preferred store of wealth that was the preferred investment asset for most of the 10 years up until 2020 affordable. So how do you do that without creating a negative wealth effect? I think you can do it, but probably allowing a small price adjustment, which is what we're doing at the moment in order to keep developers profitable, is working against that rather than for it. So I think we probably need to see real estate cheaper, because what we absolutely need to see is households have confidence that it will start to go up in price again.
The other similarities, we've talked a little bit about excess savings levels that are just sitting idle, but also the demographics, right? The aging population, the issues that they had, even with abandoning largely the one-child policy. Does this mean we're settling in for, a structural slowdown that is going to be structurally lower growth for longer in China? This is going to be the new normal. Can they do that without a prolonged period of stagnation?
Look, I think there's two questions. There's where are we on a credit cycle or a business cycle that we've talked about, and there's what the sustainable rate of growth is. I think Beijing accepts that the sustainable rate of growth is getting slower, because it's happened to every other country as its population ages and it gets richer. And I think it's reflected in how Beijing has set growth targets. So 15 years ago, a growth target would be 8%. Today, the growth target is 5%. So I don't necessarily associate that long-term slowdown with either stagnation or economic weakness. It's just a reality of the fact that there are now fewer consumers joining the labour force every year, and those workers that you do have tend to be more elderly, which means that they save more. That's inevitable. It's not an economic problem either for Beijing or for financial markets, unless there's an attempt to achieve a growth rate that is simply now unachievable.
So what does that new reality mean for other Asian economies that are much more trade dependent on what happens in China?